Good morning, everyone. Welcome to lesson 4, which is going to be on divergences. This lesson has been a long time coming. We've had several requests for more of the learning videos that I put out on YouTube. This is lesson number 4. Number 1 was Elliott waves. Number 2 was corrective patterns, and number 3 was Fibonacci retracement and extension. So now I'm going to be showing you how to detect and draw out divergences, and we're going to define all that. So you have on your screen what are divergences. So basically you're measuring price action versus momentum indicators, which can be volume, relative strength index, MACD. You can use rate of change, ROC. And what divergences help us do is to detect a change in market momentum. So a quick and easy example of that would be the price continuing to go up, but you have indicators of momentum that indicate that actually there is weakness in the move. Lower volume, lower RSI, MACD is also lower. We're going to dive into that into more detail right now, actually. So right here we have the Elliott waves on there. I'm not going to delete those, but I am going to pull up the oscillators. So on top we have the histogram. Let's just zoom in just a little bit. Yeah, histogram. I don't like using MACD a lot, so I have the MACD indicator and I just have the histogram selected. Maybe you want to do the same thing. I'm not saying MACD is bad, you can use it if you want, but up here we have the histogram. So if we measure, we could probably zoom in here and find some good examples on Bitcoin. Let's take this move to the top, specifically the top of wave 3 here. Actually, you know what? Let's get rid of these waves. Just keep the numbers up there. So what you want to do is, well, first of all, let's put this down. When you're measuring bearish divergences, you're going to be measuring at the top of the move. So, like so. And when you're measuring for bullish divergences, on the other hand, you're going to be measuring at the bottom of the price action. So let's look at price action where there are no divergences. So we're going to measure the top of this move right here. Something like this. And there's not much to see on the histogram, so let's just look at it. So you have that here, like so. And zoom in on the RSI, draw the same lines. Okay, actually for this example, let's get, we don't need the MTF for the moment, it's too much noise. And this one might not be relevant, but let's draw it out anyway. For all intensive purposes, the price action agrees with the momentum indicators. So histogram agrees, the trend is up. There is no divergence to be had there. And the same thing could be said for the downward movement. Like if we measured here, we measure it here. It happens sometimes that you won't have an agreement across all oscillators, that doesn't mean that there's a divergence. The more momentum indicators that agree together in the divergence, the stronger it is. So for example, if your price keeps going up, like in this bearish case here, but your momentum indicators, they keep getting weaker, right? Okay. RSI, it starts even earlier, you know. But the point is, they all agree. You have your divergences here, and on the bottom, the rate of change, same thing, gets lower. I mean, there's a little pop out here, but you get the gist of it, right? So here you have a clear divergence with the price rising 3 peaks, and you have your momentum indicators, histogram, RSI, ROC, and I'm sure, just for the fun of it, let's pop in the MACD. Let's also add, I will delete these after because I absolutely like to have the minimum of indicators that I absolutely need on my page at the same time. So let's add as well stochastics RSI. Okay. See the MACD almost replicating the other ones as well. So let's add our line. This one maybe does not go down, so let's start it here, like so, and it goes and it stays under the 0 line for a while, you know. And stochastics, let's just zoom it out a bit. Yeah, since this oscillator is the 0-100, and you might find some divergences like here, but they're not as strong, so I don't like to use it for that. I'd prefer to use Crypto Heat's MTF indicator for fakeouts. There's a way to measure divergences on that as well, but we can get to that in another video. So yeah, when the price action and the momentum indicators agree, there is no divergence. When they disagree, there is a divergence. So I've showed you the bearish version, and what happens after the divergence is present. Okay? If you have a bearish divergence, you're likely to go down, right? And on the other hand, if you start measuring the bullish divergences, here we have downwards and upwards again and again, and even on MACD. I'm gonna cut this out right now. Go put it back later if we need it. But this is another 3 indicator strong bullish divergence. And what happens in that case? It goes up. One of the subjects that fired up all of this need for a divergence course is I had a slight disagreement with one of the members lately, and it's just to speak as to where it's divergent and where it's not. Okay, so I'm just going to try to find a chart where I can illustrate that really quickly, easily. So I need something with nice waves. So I zoomed in here a bit. I'm just going to try to find something real quick. I've found it on AVAX. Alright. So basically what I believe, I mean, divergences are traded in so many different ways. I mean, there are wrong ways to trade them, but I'm going to show you the way I like it, because I personally like to I like to nail the bottoms. So okay, actually I'm going to, let's shorten this out. Okay, so I'm looking for a bullish divergence right here. Here you had a mini one, or you could have pointed this bounce here, but that's not what we're looking for. So we're going to align ourselves with this one. So this is your divergence right here. Do it on ROC as well. See, ROC in this case, it didn't detect this divergence where RSI did. So it's important to have a few good indicators that you trust, that you can work with. So for me, Floki, the divergence is right here. Oh, let's go back, and I just want to zoom in. For me, the divergence zone, where I could still say, hey, we're divergent, you know, is from the bottom of this one to the bottom of this one. Okay. So for me, I know some people will trade the retest. So in this case, you have right here, this would be the retest. Okay, let me just type that out. This is the divergence. This is the retest. Personally, I will trade both of these anytime. But for me, the divergence, if I had to draw a square around it, is right here. As soon as you go above this line here, to me, it's no longer a divergence. The divergence has, at least in part, played out, and it did up to here. In this case, the divergence bounced 35%. That is a huge bounce if you're trading leverage. On a 10x leverage trade, this is a 350% trade, which is amazing for anybody. So yeah, for me, the divergence ends. So we have what? 26th of May, 1800 hours until 28th of May, 8 a.m. So the divergence lasts for 2 days for me. After this, the divergence is over, and this part is called the retest to me. So I just wanted to make that clear. So basically, what I'm trying to explain to you guys is a divergence will help you detect a change in momentum and market psychology. A bounce is always imminent, but that does not mean that this trend is going to reverse. It doesn't mean it's going up like this. It just means we needed a correction. A bounce was needed. Because if we zoom out, you can see trends. The trends can tend to continue more than they tend to reverse. And trying to catch that bottom bounce is not something that we necessarily recommend all the time, but as traders, as technical analysts, we're going to try to find it anyway. And yeah, the more we zoom out, the higher time frame your divergence is on, the higher chance of a bigger bounce where you can get those 35, 50, and 100% bounces. Because I mean, let's see here. Let's go back to lesson 3 and measure a fib just for the fun of it, right? So we have the all-time high here, $147 on AVAX. So if we do the Fib retracement, let's say the bottom's in, right? The bottom's in. We know that a retracement to the 236 Fib level is something standard and conservative. So if we measure the bounce from 0 to 236, I'm sure it's going to give us a huge number. There you go, 137%. On the 10x, that's 1,300%. So we put $100, comes up to $1,300 roughly. So that's why divergences are so important. I mean, you could see them all day, every day. But the trick is to use all of the lessons. Elliott wave, correction, Fibonacci, and the next lesson that's coming is going to be to draw trend lines, supports and resistances, which is also going to be very important. Get those tools in your toolbox. Gain risk management and try to trade like a robot, and you will get better at this. So I'm going to pull up the first screen again. There we go. So if you haven't followed me already on Twitter or TikTok, go ahead and do that at Floki Crypto. And yeah, come and see us at the Discord Foundry. We can give you a trial. It's very worth it. We trust our product so much that we'll give you a whole month free, and you can earn your monthly fee in 1 or 2 trades. It's not a problem. So yeah, come and check us out.